Let's talk OPEC and the broader markets now. Futures are flat as stocks get ready to kick off a holiday-shortened week with the S&P sitting at a record high. Joining us now, Sarat Sethi, managing partner and portfolio manager at DCLA, as well as a CNBC contributor. We do talk about the T word, transitory, all the time in terms of inflation. How does this news from OPEC and looking at oil at multi-year highs, how does it play into the whole notion that it is something we need to watch?
It is transitory. I think what's going to happen is if you look at oil today, it's back to 2014 prices. But as soon as you see this happen, Joe, oil reaching close to 80, 85, there are so many producers out there that are non-OPEC, whether it's Russia, Iran, and then us as well. And because it's a commodity, the production's going to come on, and we're going to see prices kind of stabilize. But at this point, you know, the winners are really the producers at this point. And actually, you know, the Middle East needs oil prices at these levels. So for them, for oil to go down from here is actually not positive. But I do think as oil goes into the 80s, you'll get a lot more production. I mean, just like we saw last year when oil went to negative. So I'm not really concerned longer term, but I think shorter term, this will, you know, obviously companies will have to pass some of these prices on to consumers.
Brian was talking about, you know, how much additional oil domestically we were producing, but that got shut down, and it takes time to bring it back online. Sarat?
It does, but if you look at how fast it could come on, Joe, it will be pretty quick because some of these drills, I mean, we're in depletion mode. We really haven't drilled for new oil. We still have oil here, and this is why some of the big boys, the Chevrons, the Pioneers, they're going to do really well because they can produce this oil pretty quickly and really at good profit margins too. So I'm not concerned about it. What I just think in the short term, could this just be a little of an additional tax on the consumer just as we're getting our economy ramping up? But I do think those companies that can pass this through are going to do really well. Those that can't, I think you're going to see some effect on profit margins.
Sarat, the 10-year, as we reopened, was supposed to go above 2%, and it hasn't. Meanwhile, individual investors plowed $23 billion into the markets last month. You saw that in the $28 billion. Sorry, $28 billion. So what are we to think about that? The other big problem would be if interest rates went up for government funding and for individuals, and that's not happening either. So it's just clear sailing.
You know, all these signs to me is everything is perfect, and that worries me. I mean, we've had since October, a 5% correction. That's it. I mean, last month, the market maximum movement was 1%. So I do think we're in a little bit of a euphoria short term. You know, individual investors are coming after returns that they probably, you know, maybe didn't get over the last year. I think we just have to be careful. Economy's in great shape. Things like high oil prices and interest rates, which are lower, are actually, the rates are good. So I do think companies will do well, but we do need to be careful. And I do think you want to be in secular growth companies, not just chasing the market in here, because I do think the market's going to be very picky as to what sectors are going to do well. And if you got pricing, whether you're in industrials, you're in energy, and even financials, I think those are going to do well. No question tech's going to do well too, but we have to be careful because I do think at 1.44 or 1.4, rates are probably going to head up higher than lower. And if that happens, the movement on especially the higher speculative stocks could be very, very sensitive. So
do you talk about
Washington? I am positive, but I think short.
Yeah, do you talk about Washington? Would an infrastructure deal be a positive for you if it was followed by another 2, 3, 4 trillion in spending? Would that be initially positive for the markets, or does there come a tipping point where we worry about funding all that?
You know, it's one of those things where I think the market will interpret it a little bit negatively, because if you do have 3-4 trillion coming, how are we going to pay for that? And I think that could put an effect on interest rates that we're not expecting, because at the same time, the savings rate for the consumers is so high. So we are going to have a lot of money then chasing products in a supply-demand imbalance, and that could be one of those perverse things that's what you think is good for the market could actually be bad for the market.
Shepard Smith here. Thanks for watching CNBC on YouTube.